Time now for Options Corner. Joining us now to take a deeper look at AMD is Rick Ducat, lead market technician. All right, Rick, let's talk about this chart and the trends that you're seeing for AMD.
A difficult time for this stock, to be sure, and really it looks like the pain is kind of increasing. We can see that we had this downward sloping trend here, our purple trend line going across these highs, and the trend has steepened to the downside with this shorter term white trend line that's remained fairly consistent during this past couple of months here. We're near the 52-week lows, 112.80. We have earnings today, so that could be a major catalyst here. RSI triangular shape just kind of compressing here as we approach this event risk situation. Notable volume nodes near 125, 140, and 165, Diane, as we assess this ailing stock, I guess we would say.
I know. I mean, it's been fascinating to watch the performance of AMD, especially when you say compare it to like NVIDIA. But let's talk about some of the options activity that you're paying attention to. What kind of options activity did you see in AMD yesterday?
Well, because we have earnings, I decided to look at the open interest for the February 7th expiration. On the call side, the big strikes are 120, 125, 130, and 135. On the put side, 100, 105, 115, and once again, that 120 strike here. So that seems like a key one as we head into earnings here with this weekly expiration. The biggest single trade yesterday was a long calendar, call calendar, plus 2,000, September 19th, March 21st, 120 call calendar at a 924 net debit. So this was about a $1.48 million debit here. Looked to be an opening trade, Diane.
All right, Rick Ducat, lead market technician with some of the options activity around AMD plus the chart. Now to take us through an example trade, we've got Tom White, co-host of Fast Market and senior options contributor. All right, Tom, how would you go about an example trade when it comes to AMD, especially with earnings in front of us?
Yeah, implied volatility levels elevated at this point, Diane. Not surprising going into this event risk. The option market's pricing in about a plus or minus 8% move in the shares either way for this stock post earnings. Now, remember, last quarter they beat on EPS, they beat on revenue, both slightly, and the stock dumped over 10% the following day on the weaker guidance that's expected. So I looked at this from perspective of, as Rick mentioned, the stock's been under pressure, down over 30% from year-ago levels, off nearly 50% from all-time highs that we saw just last March. So over the last 11 months, we've seen nearly a 50% decline in the share. So I'm looking at volatility levels and dispersion between option series here in this example trade. If you think this stock's going to rebound, this is a type of strategy that takes advantage of it. So I looked at a bullish call diagonal. And the composition of this trade is where I'm going to go out to the February 21st monthly cycle, so 17 days to expiration, and I'm going to buy the 115 strike call. That's currently at the money. The stock's trading just above 115 here in the pre-market. And then against it, I'm going to go out to the February 7th weekly cycle that expires in just 3 days and sell the 124 strike call. So a bullish $9 wide call diagonal to the upside. I've got a couple weeks in this position. And I'm going to pay for a $9 wide call diagonal. I'm going to pay about a $470 debit on opening prices about where they're going to open up here this morning. So that debit that I pay, $470, is going to be my risk, $470 per spread. But you can see here from the risk profile, it sets up for an upside move here with the apex of profitability being at or near that 124 strike. So you're looking for the stock to move about that one standard deviation that the option market's pricing in at this point, which would be at or near that 124 level here. Now, your break even where you're going to be profitable on this, probably going to be about 118. Anything above there post earnings is going to be profitability on this one. Now, I talked about volatility dispersion and why this is such a low cost call diagonal based on a $9 width of it. And that's because I'm buying under a 70% implied volatility in the February 21st weekly options where I'm buying that 115 call and selling about 117% implied volatility levels in the February 7th 124 strike call. So that vol dispersions lowers the price. That's lowering the risk on this potential bullish trade here. So if you think this stock's going to rebound, this strategy takes advantage of it, and you get that vol dispersion, which lowers the input cost on this position.
All right, that's an example trade, bullish call diagonal there from Tom White, co-host of Fast Market. Thanks a ton